Welcome back to the Deep Dive.
Yes.
Today, we're dissecting an Investor Place article titled
Okay.
5 Stocks to Buy on a Trump Victory, published on November 10th, 2024. So just days after the election.
Yeah.
Everyone's trying to figure out
Sure.
what a second Trump term means for their portfolio.
Exactly.
This article gives us 5 potential winners.
Okay.
But as always, we're going to go beyond the headlines and really unpack the reasoning behind these picks.
You're right. Predicting the market is never a simple task.
Right.
But this article gives us a framework
Okay.
for thinking about how political shifts can influence specific sectors and companies.
Yeah.
All right.
Okay, now that we've warmed up,
Yeah.
let's get into the real meat of this article.
Sure.
What I found fascinating is how it connects the dots between Trump's actions during his first term and potential market trends during his second.
Exactly.
Right.
It starts by laying out the Trump effect, reminding us of the stock market's performance during his previous presidency.
Right.
Remember the S&P 500 saw
Yes.
a pretty substantial surge, rising by 67%?
Right. And they specifically point to Boeing as an example of a company that thrived under Trump.
Yeah.
It's not just about the overall market performance, but also how specific companies can be impacted by a president's policies and actions.
The article claims that Trump helped Boeing secure some lucrative business deals and contracts. In return, Boeing agreed to build a new Air Force One at a price below market value. Well, they may have taken a hit on that specific deal. Their shares soared by as much as 200% at one point.
That's a pretty striking example of how close ties to a president can translate into stock market gains. But now let's shift gears to Tesla, which the article portrays as another potential winner in a second Trump era.
Okay.
I was intrigued by their argument that Tesla might actually benefit from a more favorable regulatory environment.
It is interesting that the article highlights Elon Musk's past support of Trump, speculating that this relationship could lead to advantages for Tesla, like access to government funding, or perhaps a lighter touch when it comes to regulations.
But the article also acknowledges that Tesla's valuation is, let's just say, unconventional, right? Their stock price has been on an absolute tear, soaring over 1,150% in the past 5 years to reach a market cap of $900 billion.
Wow.
Yet their earnings haven't necessarily kept pace.
Right.
And they're facing increasing competition, especially from those Chinese automakers.
You've hit on a crucial point.
Yeah.
The article even uses the term wizardry to describe how Musk has managed to maintain such high investor enthusiasm despite those seemingly contradictory financial figures. Yeah. And they speculate that this superpower, as they call it, might be amplified under a second Trump presidency.
So essentially they're saying that Tesla is a bit of an enigma by traditional valuation metrics. Right. It doesn't quite add up.
Okay.
But there's this intangible factor.
Yeah.
Maybe it's Musk's charisma. Maybe it's the company's innovative image that keeps investors bullish. And they believe a second Trump term could fuel this even further.
That's right.
Okay.
The article doesn't shy away from the fact that there are risks involved. For example, the relationship between Musk and Trump could sour. Or the factors driving Tesla's unconventional valuation could shift.
Those are important caveats.
Yeah.
But overall, the article seems to lean towards the idea that Tesla's stock is more likely to head upwards than downwards in 2025.
It'll be fascinating to see how this plays out. But let's move on to another sector the article highlights. Energy. They argue that Kinder Morgan and Halliburton are well-positioned to benefit from a pro-drilling environment under Trump.
Let's break down why. Starting with Kinder Morgan. The article really emphasizes their stability, pointing to their consistently strong operating profit margin, 23% over the past 5 years. And their robust annual free cash flow exceeding $3 billion.
And here's what's interesting about Kinder Morgan. As a pipeline operator, their revenue is largely tied to the volume of oil and gas they transport, so they profit from increased drilling activity. Regardless of the fluctuating price of oil, it gives them a certain level of insulation from market volatility.
So even if oil prices take a dip,
Yeah.
As long as the volume flowing through their pipelines remains high,
Exactly.
Kinder Morgan is in a good spot. And the article mentions that their significant domestic business also acts as a buffer against potential trade wars or tariffs.
Exactly. They control a large portion of America's natural gas pipeline network, which makes them a crucial player in transporting hydrocarbons within the U.S. This domestic focus gives them a level of stability that companies heavily reliant on exports might lack.
So they've got the stability angle covered.
Yeah.
But what about growth potential?
Well, the article sees the real upside for Kinder Morgan in the potential for increased LNG exports. If global trade conditions are favorable, they are well positioned to capitalize on a surge in LNG demand. They could potentially even double their current LNG handling capacity.
That's a significant potential catalyst for growth.
Yeah.
And even before Trump's victory, analysts were predicting a 7% rise in their free cash flow per share in 2025. Driven by rising natural gas prices.
And don't forget, their stock is trading at a reasonable price-to-cash flow ratio. The article suggests we could see their stock jump by 20% or more next year.
That's pretty compelling.
Yeah.
Okay, now let's talk about Halliburton.
Okay.
The other energy player the article highlights.
Right.
They're much more directly involved in the drilling process.
Right.
So they stand to benefit even more directly from a pro-drilling environment.
The article cites a few potential policy changes that could boost Halliburton's business. Rolling back those methane emission regulations. Opening up federal lands in Alaska for drilling. And restarting approvals for new LNG export terminals.
All of those moves would translate to increased demand for Halliburton's services. And even before the election, analysts were forecasting a 9% rise in their earnings per share for 2025. Now, with Trump back in office, those estimates are likely to be revised upwards. But the article does inject a note of caution here. They point out that it's difficult to predict the exact impact of Trump's policies on drilling demand. Remember, even during the Biden administration's push to curb emissions, energy companies continued to increase production. That's a good point. So while a Trump presidency might create a more favorable environment for drilling, it's not a guaranteed slam dunk.
Exactly. And for that reason, the article actually advises against investing in smaller, more vulnerable players in the oilfield services sector. They recommend sticking with the established giants like Halliburton, which offer greater stability and earnings potential.
So we've covered Tesla. And the potential boom in the energy sector. But the article also dives into another area that often reacts strongly to political shifts. The world of Bitcoin. What'd you make of their analysis there?
Well, they start by pointing out the immediate impact of Trump's victory on Bitcoin prices in the hours following his election. Bitcoin surged by as much as 7%, reaching $75,000.
Wow.
It seems like crypto enthusiasts are optimistic about a second Trump term. Perhaps expecting a more relaxed regulatory environment. Potential tax advantages. Yeah.
Interesting.
It's fascinating how quickly the crypto market reacts to these kinds of political events. And while the article acknowledges the inherent volatility of crypto, they do highlight two companies they believe are well positioned to benefit from a potential Trump-driven crypto surge: Coinbase Global Inc. and Robinhood Markets Inc.
Those were interesting choices, especially since they focused on trading platforms rather than Bitcoin mining companies. What's the logic there?
They argue that Coinbase, being the largest U.S.-based cryptocurrency exchange, stands to gain the most from a surge in Bitcoin prices. More users will be flocking to their platform to buy and sell, boosting their transaction fees. Plus, analysts are already projecting Coinbase to generate $1.5 billion in profits this year, with a remarkable 26% profit margin.
So they're already a highly profitable player in the crypto space. And a Trump victory could potentially supercharge their earnings even further. But the article also mentions another factor that could benefit Coinbase: a potential change in leadership at the SEC.
Right. Remember, the current SEC chair, Gary Gensler, has taken a pretty tough stance on crypto regulation. He even filed a lawsuit against Coinbase last year, alleging they were selling unregistered securities. A more crypto-friendly SEC chair under Trump could ease those regulatory pressures, allowing Coinbase to focus on growth and expansion.
It sounds like they're betting on a more laissez-faire approach to crypto regulation under a second Trump term. And what about Robinhood? They're not exclusively a crypto platform, are they?
No, they're known for their mobile trading app that gained immense popularity, especially among younger investors. But the article argues that a second Trump term could recreate the kind of market volatility we saw back in 2020, particularly around meme stocks and smaller cryptocurrencies like Dogecoin.
Ah, the days of the meme stock frenzy.
Yeah.
So they're suggesting that Robinhood would benefit from a more chaotic, unpredictable market.
Precisely. Their platform thrives on active trading. The more volatile the market, the more trades are executed, and the more revenue Robinhood generates.
And similar to Coinbase, they could also benefit from a potential shift in SEC leadership. The article points out that Robinhood is currently facing some regulatory hurdles in their efforts to expand into things like 24-hour trading and event betting. A more lenient SEC could pave the way for them to move into these new areas.
That's a good point. It seems like a recurring theme in the article is that certain sectors like crypto and energy might see a significant regulatory easing under Trump.
It's definitely a key factor to consider.